I'm putting £10 a day into the stock market for 30 days to show you how this investing stuff really works. I've been investing for well over a decade now, making over 6 figures in the process, and I know I'm constantly telling you guys on this channel to invest for the long term, but the craziest thing is I have absolutely no idea how this challenge is going to go. To step things up, I'm making this a battle, putting the S&P 500 over in the US where Trump comes into power in just 13 days time versus the UK's FTSE where things haven't been that great since Sir Keir stepped into the hot seat. January used to be called the January effect where markets would tend to do very well, but in recent years this definitely hasn't been the case. But could this month buck the trend? Okay guys, let's invest our first £10. But first, some simple ground rules. To keep things simple, I'm going to be using funds rather than selecting individual businesses. Funds are like boxes of chocolates where you buy lots of companies in a single basket for a single price. They are perfect for beginners as they're cheap and they're very difficult to beat versus investing into individual companies. Now over in the red corner, I'm choosing the S&P 500. He's weighing in at 500 of the largest US companies, including the likes of Apple, Tesla, Nvidia and Microsoft. The S&P 500's record over the past year has been 27% wins and no losses, a very tough competitor. And over in the blue corner, we have the FTSE 100 and the FTSE 250 weighing in at 350 of the largest UK companies, including the likes of Shell, Burberry, Greggs and Ocado. Now the FTSE 100's performance in 2024 was 9.7% wins and no losses, and the FTSE 250 was 8.7% wins and no losses. So ladies and gentlemen, let's get ready to rumble! Now Jeff, it's very interesting because Shami has chosen to put £5 into the S&P 500 and has £2.50 going into both FTSE funds every single morning. Totally Bob, it's a simple process but one that makes it very interesting to watch for the neutral. Totally Jeff, who knows how this will play out? It's looking like a David versus Goliath type battle, and Jeff, I think the S&P 500 is poised for an early knockout, but let's strap in as the bell is about to go. Right gang, before we kick off this challenge, I'm going to show you how we're setting this up. We're going to be using the investing app Trading212 as I personally have my own account with them, and they have a wicked little feature called Pies which will help us keep track and handle the investments. Now the Pies feature allows me to bunch funds together, and if I wanted to I could add a range of stocks in here as well, but what this is going to do is allow me to split it evenly with my £10 contribution. Now just quickly, Trading212 have provided you guys watching this a free share worth up to £100 when you deposit just £1. You can use the code GAINS on sign up, or if you signed up in the last 10 days, you can head to the promo code section and add it into your account for your free share. Just make sure you're aware that when you invest, your capital is at risk. Now, I'm going to quickly navigate to my Pie section and build this out. I'm going to add in the S&P 500 and the 2 FTSE funds inside here. And then I'm going to split up my allocation. So 50% to the S&P 500 and 25% each into both FTSE funds. Then select invest, choosing £10 here. I'm going to stick it into my target split of 50, 25, 25. And I don't want it to rebalance automatically, so I'm going to set it to target. There is another reason why I like Trading212 is they offer fractional share investing, essentially allowing you to start with £1 if you really wanted to. Okay, so I'm going to place that buy order, and just like that, it's done. And once the market opens up in a few minutes, we are away, people. So who are you backing to win this fight? Is it the UK or the US? Let's check back in a few days' time and see how this is all going. Wow guys, what a day it has been in the markets today, and it is only day 2. Now the FTSE 250 sold off by a whopping 1.99% today, and that's because fears around inflation being a bit stickier. It actually jumped up to 2.6% from 2.3% recently, and the Bank of England have said that they may not cut rates as fast as they would have liked this year, which has shot bond yields up, and that has meant the UK's borrowing costs as an economy have risen higher than forecasted, and the markets really did not like that at all today. Interestingly, the UK 100, the FTSE 100 is up 0.07% today, so not as big a loss as the FTSE 250, and the S&P 500 at the time of recording is up 0.41%. So the UK is dragging our challenge down at the moment already. Who'd have thought it? But there's a long way to go, and stay tuned. Over the next few days, I'll be back with some more updates. All right, let's unpack this a touch more so you can actually understand what has been happening here. The cost of the UK government's borrowing, basically how much the government has to pay in interest to actually borrow money, has surged. Now, this is because of what's happening with bonds, which are like IOUs from the government or companies as well. When fewer people want to buy government bonds, or gilts as they're known in the UK, their prices go down and the interest or yield that the government has to pay goes up. Think of it like this. If someone's not excited to lend you money, you might have to offer them a bigger reward to basically convince them, which is kind of why the FTSE 250 reacted like it did today. Inflation in the UK has crept up to 2.6%, which is much higher than the Bank of England's 2% target. And this makes investors nervous because inflation reduces the value of the money they'll get back when the bond matures. In the US, inflation is also above target, and there's new data suggesting prices in services are rising again. And this has made people worry that interest rates set by the central banks like the Bank of England and the Federal Reserve might stay higher for longer than expected. For the UK, the pound has also dropped in value against the dollar, which can make importing goods more expensive. So the pound to dollar exchange rate shows how many dollars you can buy with £1. If the pound weakens, it means each pound buys fewer dollars, so fewer products. But why didn't the FTSE 100 drop along with it? Well, I think it's a good time to explain the differences between the two FTSE funds, as it's a good indication as to why. Now, the FTSE 100 contains the 100 largest companies in the UK, many of which are multinational corporations. You think of companies like Shell, Unilever, HSBC and Diageo. These companies earn a significant portion of their revenues from overseas, so they're less dependent on the UK economy. And the FTSE 250 contains the next 250 largest companies in the UK, which are overall pretty much more domestically focused. And these are companies like Greggs, ITV, Britvic and Deliveroo, alongside many more, which you can also see here. Going back to the pound dropping against the dollar, this actually can benefit many FTSE 100 companies, since many of these companies earn in dollars or other foreign currencies. A weaker pound increases the value of their earnings when they convert them back to pounds, whereas with the FTSE 250, companies are more reliant on the UK economy. These rising concerns about inflation and higher government borrowing costs will spook investors, as these factors can hurt consumer spending in the UK and therefore business growth in the UK as well. So in a nutshell, the markets are jittery today because of inflation sticking around, and that's led to big movements in bond yields and currencies, but we are only in day 2, so I'm going to see how this plays out in the next few days. I'll check in with you soon. So day 9 of investing £10 every single day into the stock market, and it's been a big day in the markets today as both the UK and the US rallied off the back of latest inflation data. And starting over in the UK, inflation fell to 2.5%, which is a lot lower than the forecasted 2.9%. And this has meant the odds of the Bank of England lowering interest rates in February shot up to 74%. And both our UK funds really did like the news. Our FTSE 100 fund is up 1.13% today, and the FTSE 250 fund is up 2.81%. And over in the US, inflation did rise up to 2.9%, but it came in lower than the forecasted 3.3%. And the US markets liked it as well. Our S&P 500 fund was up 1.38% today. So after being down, we're now finally in the green, and we're up 1.14% or £1.03. And this just goes to show you how quickly things can change for the better or worse off the back of key data like inflation. And I'll catch you guys in a couple of days' time. Okay, so let's unpack why inflation has such a big impact on the markets. Well, to understand this, we have to look back at 2020 when the pandemic happened. In the following years after this, inflation rose massively in the UK and the US and all around the world, really, to be honest. And to counter this rise, the central banks had to raise interest rates, and they did so quite quickly. Now, before 2020, we had some of the lowest interest rates we've ever seen, and this meant taking out debt was extremely cheap for both businesses and everyday people like me and you for things like loans and mortgages. Equally, when rates are higher, those with capital to invest have been safely getting 5% savings from their banks. We've also seen inflation fall to 2.6% in the UK and around 3% in the US, but savings rates are still much higher than inflation, meaning we're in this odd period of history where inflation isn't actually actually eating away at your savings. Now, when inflation comes in lower than expected, this fuels chatter around the central banks continuing to lower rates, which did start happening earlier in 2024. Now, if rates do come down more, capital usually goes into the markets and businesses can afford to take out more debt to fund growth, which is a good thing for asset prices like stocks and our funds as well. Now, the loser here in this situation is savings accounts, and as rates come down, those attractive savings rates we've been getting aren't going to look so good anymore, and people will have to look to the stock market again to start beating inflation. Wow guys, it is day 20 and our portfolio has taken an absolute battering today. The S&P 500 was down 2.13%, wiping out all of our gains, and we're now down by 1.04% on the S&P 500. And this was due to big news in the AI world. A Chinese ChatGPT competitor called Deepseek broke the internet today and soared to the top of the download charts on all of the app stores. And they basically managed to create an AI model for just $5.8 million versus the billions of dollars it's taken to actually build ChatGPT. Equally, the amount of NVIDIA chips it actually requires to run versus ChatGPT and Claude and all these other AI models is a fraction of the processing power that these guys are using. Now, with the US's AI investment now under intense pressure, NVIDIA was down 15% today at the time of recording this. And the rest of the market has actually followed along with it, with the likes of Microsoft, who are OpenAI's, the owner of ChatGPT's largest investor, also down 3.6%. Now, our FTSE 100 fund held a little bit firm today, edging up 0.03%, but the FTSE 250 was also down and had a rough day today, down by 0.74%. So guys, it's all happening right now, and we are now down a little bit, but hopefully things will improve. Markets are going to be very volatile this week, and I'll catch you guys on the next one. Okay, so why has this happened? Well, AI has been absolutely booming since basically ChatGPT came onto the scene properly in late 2022. Now, every company and their dog have been exploring AI, and in my opinion, it's really only the beginning of this. But some have said the stock market has created what's called a mini bubble, where some AI businesses have absolutely skyrocketed in value without perhaps concrete earnings to back it up. NVIDIA has probably been the most standout performer, and in the past 5 years alone, its stock has risen 1,887%, but has a large part of its growth fueled by this AI adoption. NVIDIA creates chips for computers, but major businesses adopting AI like Meta, Microsoft, and OpenAI have been buying NVIDIA chips, as really they're the only ones creating chips that are powerful enough to run these AI models. However, Deepseek flipped this model on its head, using 1/30th of the processing power that ChatGPT runs on, and this meant that the billions and billions of dollars that have been promised to NVIDIA became under threat. Now, essentially, it's making the US look pretty foolish spending billions on AI data centers and infrastructure with these NVIDIA chips, and then this Chinese company came out of nowhere that could do it for $5.5 million. Now, with AI having driven a large part of the S&P 500's 26-27% growth last year, this news really shook the markets, and understandably so. But again, let's see how this plays out, because we've still got a few days to go. Could we see the S&P take back some of its losses? It's shown that it can do that more than once so far this month, so I'll catch you in a few days' time.
There are growing fears of a major global trade war tonight after President Trump announced sweeping tariffs on imports from Canada, Mexico, and China.
So I understand
we'll also be announcing steel tariffs on Monday.
Tomorrow?
Monday, yeah, tomorrow.
Okay, so today is day 27, and wow, Trump is really throwing his weight around a lot due to concerns about illegal immigration and other naughty bits and bobs coming across the Mexican and Canadian borders into the US. Now, he's basically saying he's going to impose a 25% tariff on these two countries. Now, the definition of a tariff is fairly straightforward. It's tax on goods coming from another country. Now, the markets don't like this because tariffs can lead to disrupting trade and also lead to higher prices for consumers and potentially even provoke retaliation from these affected countries. And this creates volatility and uncertainty in financial markets, which generally react quite negatively to economic disruptions like this. Now, Trump never fails to keep things interesting, to say the least, from political and economic standpoints, but no doubt over the next 4 years, there's going to be many more bumps like this in the road, both up and down. Now, guys, I'll see you in a couple of days' time when this challenge is ending and we can review the results together. Today marks the last day of the challenge and the markets have just closed a few minutes ago, so I'm striking while the iron is hot. And after being down on Monday, we're now back up in the green all around after a storming day today. UK lowered interest rates, and as we know, that's usually a good thing for markets, and both our FTSE funds really liked the news. The S&P 500 has also recovered a lot of its losses just to get us into the green as well. So not a bad ending. After I thought we might actually end the month with some pretty poor results, we've actually done all right. Now, it wasn't all good news for the UK, with Andrew Bailey, who heads up the Bank of England, slashing the UK economy's growth forecast in half, which adds further pressure to an already unpopular Rachel Reeves and Keir Starmer right now. But without getting too political here, this is something to keep an eye on, as inflation could well be back on the rise in the coming months. But let's get into the results. Tossing this all up, we added £300 to our portfolio over the past 30 days, and we're up a total of £5.69. But to add this all up, we have got to see who wins out of the UK versus the USA. Now, the S&P 500 fund was up 0.72% for the month, and our FTSE 100 fund was up an incredible 3.32%. What a month for the FTSE 100. Now, our FTSE 250 fund was also up an incredible 2.83%. Now, even though we had half the amounts going into both FTSE funds, they have individually smashed the S&P 500 to pieces here. It's a total knockout. Now, adding the two funds, the two UK funds together, we're up £4.61 versus £1.08 for the USA. So it's a 3x win for the UK. The Brits have absolutely smashed this by some distance. Now, I'm sure that'll be a bit shocking for some of you guys watching this. The S&P 500 has consistently outperformed the UK for a very long time now, but it just goes to show that in the short term, markets can be very different indeed. Now, the key takeaway here is that this is just 30 days of data. I like to think in years, sometimes 5-year chunks, and sometimes even decades ahead. So whilst it's been fun in the short term, I always encourage you to think long term with your investments, especially when you're starting out as a beginner. Let me know if you'd like to see me do more of these challenges and your thoughts on actually how this went in the comments below. But for now, I think the best video to follow on from this is actually my how to invest £100 a month investing for beginners guide, which is up on screen right now, and it lays exactly how to set up a portfolio of investments. And I'll see you guys over there. It's been real fun. See you on the next one.